Have you ever wondered how some investors profit when the market is falling? Let's explore the fascinating world of short selling, a strategy that allows you to make money when stock prices decline. What is short selling? For advanced investors, short selling involves complex margin mechanics. When you short a stock, you must maintain a minimum margin requirement, typically 150% of the shorted position's value. This includes the proceeds from the short sale plus an additional 50% as collateral. The mechanics of short selling involve a process called securities lending. Brokerages maintain a pool of shares available for shorting, known as the securities lending inventory. The availability of shares to short is measured by the short interest ratio, the number of shares sold short divided by average daily trading volume. When short interest exceeds 20% of float, available shares, it indicates significant bearish sentiment. Above 40% creates conditions for a potential short squeeze, where rapid price increases force short sellers to cover positions, further accelerating price rises. Technical short sellers utilize specific indicators like the Relative Strength Index, RSI, Moving Average Convergence Divergence, MACD, and Bollinger Bands to identify overbought conditions. An RSI above 70 often signals overbought conditions ripe for shorting. Advanced short sellers employ hedging strategies to mitigate unlimited loss potential. This includes option strategies like buying protective call options, creating a married put, or establishing collar positions to define maximum loss thresholds. In India, SEBI regulates short selling through mechanisms like the Securities Lending and Borrowing Mechanism, SLBM. Institutional investors must disclose short positions exceeding 0.5% of paid-up capital, and naked short selling, selling without borrowing, is prohibited. The cost of borrowing shares, known as the borrow rate, varies based on availability. Hard-to-borrow securities can command annual rates exceeding 20%, significantly impacting profitability calculations for short positions held long-term. Short selling creates market efficiency by enabling price discovery and preventing overvaluation. Academic research shows markets with restricted short selling exhibit greater pricing inefficiencies and are more prone to bubbles. Advanced practitioners monitor the days to cover metric, the ratio of shares sold short to average daily trading volume. A high days to cover ratio indicates potential difficulty in covering positions during adverse price movements. Sophisticated short sellers analyze financial statements for warning signs like declining cash flows despite reported earnings growth, aggressive revenue recognition, or increasing days sales outstanding, all potential indicators of accounting irregularities. Let's recap what we've learned about short selling. At its core, short selling is an investment strategy where you profit from a decline in a security's price, essentially selling high first, then buying low later. The mechanics involve borrowing shares, selling them at current market price, waiting for the price to drop, buying back shares at the lower price, and returning them to the broker. Your profit is the difference between the selling and buying prices. Remember the key risks: unlimited loss potential if prices rise instead of fall, margin calls requiring additional funds, borrowing costs and dividend obligations, and the possibility of a short squeeze driving prices higher. In regulated markets like India, short selling operates under specific frameworks like the Securities Lending and Borrowing Mechanism, with requirements for position disclosure and prohibitions against naked short selling. While short selling can be a powerful strategy for experienced investors, it requires deep market understanding, careful risk management, and sophisticated analysis of technical indicators, financial statements, and market metrics. Thank you for watching our in-depth exploration of short selling. We hope this technical analysis has provided you with valuable insights into this complex investment strategy.